The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Sean Wolbert. Thank you for joining me to review the 2014 NCUA's Supervisory Focus. The information in this presentation comes from the NCUA Letter to Credit Unions 14-CU-02 and was provided by the NCUA to assist credit unions in preparing for the exam process in 2014. The NCUA has stated that since the credit union industry has recovered from the financial crisis, that they are more able to dedicate resources to the future of the industry. Specifically, they have stated that in 2014, the NCUA will be working to ensure that credit unions identify and mitigate forward-looking risks before they threaten the viability of credit unions and the stability of the share insurance fund. The number one risk the credit union industry faces in the future is interest rate risk. Many of the regulations introduced by the NCUA in 2013 provided additional restrictions to require credit unions to address interest rate risk in many different situations and ways. Credit unions need to prepare for the rising rate environment we face. Even a slow, gradual increase in rates could have significant consequences for credit unions with high concentrations in certain long-term investments and loans. And history has shown that when a rise occurs, it will not occur gradually. NCUA examinations in 2014 will focus on evaluations of credit risk, liquidity risk, and concentration risk. As we've seen with the Target and Neiman Marcus breaches recently, cybersecurity threats have increased, and the NCUA realizes this threat to credit unions. The NCUA plans to evaluate credit unions' ability to assess and mitigate cybersecurity risks and respond to cyber attacks. Credit unions of all sizes will be expected to implement appropriate risk mitigation controls, including vendor due diligence, strong password processes, proper patch management and network monitoring, to better prevent, detect, and recover from cyber attacks. Several years ago, and it's about 2005, the Bank Secrecy Act focused scrutiny on money service businesses. Due to increased money service business involvement in money laundering, the third focus of examinations in 2014 will be appropriate Bank Secrecy Act compliance with the requirements for MSBs. A review of both the credit union's business accounts and the BSA money service business requirements early in 2014 is advised. In the last few years, we have seen increased default on student loans. In December 2013, the NCUA issued Letter to Credit Unions 13-CU-15 to clarify their expectations about direct and indirect private student loan products. Due to the increased risk in student lending, the NCUA will evaluate each credit union's student lending plans, policies, controls, and third-party vendor due diligence. The NCUA also points out that credit unions offering student loans through third parties must carefully investigate the originators and any insurer as well. The NCUA has stated in their letter to credit unions that the new regulations will also be an examination focus for 2014. The loan participation rule became effective on September 23, 2013. For 2014 examination cycle, the credit union will be expected to comply with the provisions of the new rule, including a single originator concentration limit of 100% of the credit union's net worth, or $5 million, whichever is greater, for purchasing credit unions. The 10% risk retention requirement for originating federal credit unions as required by the Federal Credit Union Act, and a 5% risk retention requirement for other originating eligible organizations, including federally insured state-chartered credit unions, unless state law requires a higher percentage. And finally, a limit of 15% on participation loans to one borrower. The new CFPB requirements that went into effect in January 10th of 2014 are also included in the NCUA's examination focus, The guidance states that compliance with the ability to repay and qualified mortgage rule will be carefully examined. The NCUA does state that in the early stages of the CFPB's newly effective mortgage rules, the NCUA field staff will take into account each credit union's good faith effort to comply. The final area of focus that the NCUA has pointed out is the new Credit Union Service Organization Rule, or CUSO rule, which is effective on June 30th, 2014. All federally insured credit unions making loans to or investments in a CUSO must now require the CUSO to account for transactions using generally accepted accounting principles, or GAAP, and prepare quarterly financial statements and obtain annual audits of financial statements. A federally insured state-chartered credit union that is or would be rendered less than adequately capitalized by an additional investment in a CUSO must now obtain approval from its state regulator and notify an NCUA regional director prior to making that investment. By June 30th of 2014, credit unions with CUSO relationships will need to update their written agreements to address the new requirements of the rule. It's always advisable for the credit union to be prepared for their regulatory examination. I hope that this presentation assists you and your credit union in understanding the focus of the NCUA field examinations for 2014. Thank you for joining me at the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.